Well, good morning, everyone. I appreciate you being here today. Welcome to the third quarter 2024 economic update. We're going to take a little look bit at the investment outlook. We promise all treats, no tricks, but we wish everyone a happy Halloween. Appreciate you joining us today. We hope, as usual, to give you a general overview of the key issues impacting the U.S. economy as well as the global economies. And we're going to focus on areas that will impact most of our attendees. As usual, we've got the international group on today. It's always great to see our folks from across the Atlantic Ocean or in the Atlantic Ocean and Caribbean with us. So we welcome you. Please note your questions in the chat box on the screen. Always look forward to answering your questions as we move forward in the Q&A portion today, or if something pops up that's a burning question, please hit the chat, throw up a hand, and let us know that you're there. Several of you have already submitted questions in advance, and we'll address some of those as we begin the question portion of the presentation. So let us review a quarter of continued growth, change, and uncertainty. For any of you on the screen that don't know me, I'm Marshall Gunn. I'm the Gunn of Gunn Company Investment Management and Gunn & Company, the CPA firm. And I welcome you, many returning, and we've got some new folks on the call as well today. So thank you for being here. The other part that I'm really pleased about is if you missed it last quarter, I want you to please join me in welcoming our newest member of the firm, Shawn McCabe. For the last few years, Shawn was the director of the CPA Alliance that we work with as co-advisors on the Gunn & Company investment management portfolios. And he was a partner with CPS Investment Advisors. And in that capacity, we were actually his client. So during that time, we were able to experience firsthand his commitment to client service. And in spite of that, we still thought he'd be great to work with our clients and be a part of our team as well. Just joking, of course. Shawn's commitment to client service is huge, and that's one of the key reasons we wanted him to be a part of our team. So he joined us as a CPA and a financial advisor, working with small businesses and individuals. And I look forward to you meeting him in person over the coming months because you're going to like meeting Shawn. He is definitely a great addition to the firm. So we're going to hear from him throughout the presentation today. I think you'll gain a lot from what he has to share. So what has happened? When we had our Q2 economic update 3 months ago, the U.S. economy was beginning to slow. Inflation was declining. The Feds were contemplating a possible rate cut or cuts before the end of the year. We had unemployment continuing to hover at all-time lows. We were optimistic about the Fed rate adjustments, that they would continue into a soft landing. We were anticipating Fed rate cuts that would be impacting the economy right about now. We'd be seeing the impact from that. Americans continue to spend money on fun with family and friends, travel and entertainment, even if they're having to spend a lot more than they did last year or the last couple of years especially. We had 2 presidents in a statistically dead heat political campaign. One of the things that changed, of course, during that period of time, for those of us that are in the Southeast, we experienced 3 hurricanes. Our family has taken it upon ourselves to unsubscribe from the Hurricane of the Month Club. We've had enough fun. I think we're done. So what does all this mean? Well, let's take a look at what the market has thought about all of this. Unfortunately, Pat Gauthier, the Chief Investment Officer with CPS, couldn't join us this quarter. So, wow, you're stuck with me to do the economic or market update. So here are the market indices. Here's some things to take a look at. And this is for just the period of January through the end of September, early October 2024. So there are many factors that Shawn and I are going to review. But basically, in spite of it being an election year, the market has done very well. As you can see by the chart, we've had tremendous volatility. You see some of those peaks, you see the valleys, but if you kind of take a look at the market, you can see that there is a linear trend for the year, and the NASDAQ has been the darling. The NASDAQ has done around 24% year to date. The S&P has been right there, just under 24% year to date. And you break that down, the Dow is around 15, and bonds have been a paltry 2%. And if it hadn't been for the rate cut shortly after our last economic update, you can see that bonds would not have been positive for the year. So, of course, depending on how your portfolio has been allocated, your personal returns could vary greatly from the indices. Keep in mind that indices are hypothetical and returns are not net of fees, nor do the returns include dividends. So it's a benchmark to measure against, but it's not an actual item. The tech-heavy NASDAQ and S&P 500 have been the leaders, with the Dow advancing less than 2/3 of what they have done. Bonds have lagged, as you would expect, but again, turned positive when the rates cuts were enacted by the Federal Open Market Committee. You may have heard about the Magnificent Seven. These are the seven really strong companies that have impacted the S&P 500. So to further break down the market performance, and this is really a almost 2-year span that we're looking at here, it helps to look at the S&P minus the impact from the Magnificent Seven. This 2-year view, as you see, there have been positive returns. Even if you were not invested in the Magnificent Seven, but if you were invested in the Mag 7, your returns were dramatically different. Let me emphasize, this is not a recommendation to buy or sell any specific security or securities. These charts are purely for informational purposes. Will this run and direction continue is yet to be seen, but with the market emphasis on companies leading the development of artificial intelligence, it does warrant our attention. Shawn, can you break this down even further for us? And welcome.
Thanks for the introduction, Marshall. And again, it's great to be here. I know I was on last quarter with you guys, and there's some new names on the registration sheet here. So thanks for having me. I'm thrilled to be here. Even more thrilled to meet and work with many of you on this call. So Marshall shared a few asset classes leading the market this year. I'd like to show you a few that are not, namely real estate, bonds, and gold, and specifically cash, which isn't on here. We'll save that one for another time. But as we look at the returns of these asset classes for comparison, note that real estate, which had a 21.31% return since the 2016, last 10 years, and bonds had a 16.45 over the last 10 years as well. They did not keep up with inflation, which inflation rang in at about 32.5% over the last 10 years. We felt that. While gold did outpace it, it did lag significantly behind the three major indices. The point here is cash, bonds, real estate, gold may not be the safe haven people think it is, especially when inflation is knocking at the door. And we all have felt it, right? As long as you've done your planning, staying invested in the market, even as we continue to print new highs, is a great way to hedge inflation and continue to build wealth. Next slide, Marshall. So let's take it from the markets and zoom out a little further, go up to the economic update for you guys, and let's check out some economic high points. So we've had a very exciting quarter. We've had a very exciting year. And frankly, you'll probably hear me say this a couple of times. I'm surprised we haven't seen a lot more volatility considering the election year. Inflation, it's moderate, but in fairness, it's kind of been stuck. The geopolitical tensions, and we're going to get into a lot of these bullet points as we move through the presentation, but the geopolitical tensions are still very highly volatile. A lot of stuff going on: Israel, Russia, Ukraine, China, Taiwan. It's all still out there. The political tensions, as we know, its main focus front and center is the elections next week. Still volatile. A lot of election turmoil. Interest rates relatively low. We had the first FOMC rate cut this year, 50 basis points, like Marshall said, after July. Got our bond prices positive for the year, which is kind of a good thing in some ways. And then unemployment, still historically low, seems to be pretty stable. And as you'll see through some of these slides, demand is still high. The Americans are still spending money. Corporate earnings didn't collapse, and some bullet points that are on the slide for you. Corporate earnings is doing great. As we're wrapping up quarter end here and getting a lot of the reports in, we're being surprised about all the expectation beats. It's a lot of fun to watch. And the U.S. economy did not fall into a recession, as some people were calling for. We have not seen market volatility typical of election cycles, which to me is very, very, very interesting. So, Chairman Powell says we're heading for a soft landing. The question is, can the Reserve monetary policy succeed? Short-term Fed funds rate sitting around 4.83%. I checked that the last couple of days. Unemployment is less than 5, inflation is less than 3, positive GDP. We're not in a recession. GDP is kind of marking time where the Fed wants it. So ideally, if you took a snapshot today of where we're at, I would say that the Fed has done a great job. Most economists think that they can pull it off, that there is a soft landing or no landing at all, and we just continue going. And being the eternal optimists that we are, let's give them the benefit of the doubt and hope that they pull it off. Appears that they just might do it. So whatever you call it, soft landing, no landing, hard landing, I'm going to call it a touch and go. We'll talk about it in a second. Growth has slowed, which is a good thing. It's generally a bad for growth to slow, but in this case, the Fed's goal is to bring growth down a little bit to slow inflation. The Fed's mandates, as we all know, is keep max employment and keep stable prices. The question is, what will growth or lack thereof be like in the remainder of 2024 and beyond? So last year, economists, Federal Reserve officials predicted that the U.S. economy would be sputtering by now as high interest rates cut into spending and investments. The opposite is happening. And again, where's the election turmoil and volatility? I'm not asking for it. I know we don't want it, but it's been kind of nice not to see the heavy volatility that we usually see going in election cycles. Recent economic data suggests the economy is accelerating despite higher borrowing costs. Chairman Powell says there will be growth over the full year. General consensus is there are more rate cuts in store for 24. Question is, where will that be? I would say if you're tuning in here and try to get some participation in here, plug in the chat where you think or what you think the Fed will cut rates to, or where you think the rates will be by the end of the year. Be curious to see what your thoughts are. Next slide, Marshall. So as we talk about the term soft landing, I was thinking about this when we were putting this presentation together. Marshall and I were talking about it this morning, but what is a soft landing? What are we actually landing? And honestly, do we want to land? And the reality behind that term, I think, is we don't want a recession, right? We want to get through a major situation like we went through in 2020 with COVID, and the economy not spin out of control, inflation go through the roof, and unemployment's going crazy. Soft landing is, hey, we felt it a little bit, we've gotten back to business, we've controlled we've slowed inflation, we've controlled growth, and now we can control things in a smooth and orderly fashion. So this slide basically says what was the investor expectations, and back in June of 23, 64% said, hey, we're going to have a soft landing. October of this year, 76% say, hey, we're going to have a soft landing. So the reality is I'm calling it a touch and go. I feel like we've been through the worst parts. I think we're pretty much finished with our election. We got next week to figure out, barring anything major happening, let's pray that it doesn't, we should hopefully see some smoothing out of this and business as usual. Next slide. And again, the talk of the town lately, besides the election, has been interest rates. Will the Fed cut rates again in 24? And I'm not sure if any chat figures have come in yet, Marshall, but if not, that's okay. We can catch them in a little bit. But to help read this chart, and I don't know how easy it is to see on your computer, but I'll explain it for you a little bit. The blue dots, the light blue dots, represent the Fed Open Market Committee members' target rate. So the light blue is from their sentiment in June for a time period, and then the dark blue is their sentiment in September for that same time period. So as you can see in 24, back in June, the sentiment was, hey, let's get rates around 5.25. Back in June, the sentiment in September, the sentiment was for the rest of 24, let's get rates somewhere around 4.25%, 4.5%. So even as we move forward through the year and as the Fed has already cut rates 50 basis points, you can kind of tell that the sentiment of the folks who are making that decision are pointing to lower rates. And if you scoot over to that second light blue, dark blue column dots there for 2025, in June, the sentiment was we're going to keep rates, the Fed's going to keep rates around 4.25. Now they've revised their sentiment down to about 3.25, 3.5. And so we'll see. That's the question. So interestingly, though, the Federal Open Market Committee begins the morning after the election and concludes Thursday, November 7th. So once the election gets done, obviously trying not to influence politics there, the Fed will start their next committee meeting, take all this data we're showing you, they'll analyze it themselves and make their decision on what's next. So GDP, as from a year-to-year perspective, has declined, reflecting the goal of no recession, aka that soft landing. I like to say it's slowed, not stalled, which is a good thing, and it's not out of control, not out of control growth, which is also a good thing. Consumers continue to spend on online purchases, dining and entertainment, but a much larger spend has been on, can anybody guess? Insurance. Yes, yes, I felt that a lot myself. I have 3 teen drivers in the house, and our insurance is very expensive. I buy a new car every year in insurance, and I'm sure everyone cringed when I mentioned that, as we feel it. But that's where a lot of the big, a lot more of the spending growth has been coming from. And we'll be breaking some of that down in the next few slides to kind of illustrate that. But all in all, Americans are spending. The Fed is doing what they can do to keep inflation in check, and the economy keeps churning. Again, Marshall and I are eternal optimists, and it feels like it's a great time to be invested in the U.S. economy. So instead of a soft landing or no landing, again, I'm going to call it a touch and go. I think this slide does a pretty good job of kind of showing, what the actual GDP is versus forecasts. And, let's give the Fed a round of applause. I think they've done a great job of keeping things on track. Not perfect. There's no perfect solution to it. But with all the scenarios that we went through in the last 4 or 5 years, when you broaden out and look at where we were back at the end of 21 at almost 8% GDP getting out of hand, and in the correction in 22 to soften things out and smooth things out to be right around their target of 3% now, I'm happy. So to that point, Marshall, the economy goes through cycles, whether or not we've controlled through Fed monetary or fiscal policy. Can you clue us in on some economic cycle of things?
Absolutely. Thanks, Shawn. As we look, there are 4 phases to the economic cycle. The early phase, where things are just getting started, you're coming out of a recession, the mid phase where growth is happening, and then the late phase where growth is beginning to moderate a little bit. So if I could take you back to that, we had 2020 and we were obviously in the recession from 2020. We go to 2021 and suddenly we're coming out of the COVID, out of the recession. It's hot. I mean, the market was running hot. So that's this early phase that we have over here. Now we've been through kind of the mid growth, the Feds have gotten control. And so economic indicators are that we're solidly in the mid to late phase of the economic cycle. There are things that say we're in mid, things that say we're in late, but it's kind of a good place to be in my environment of okay, things are a tiny bit more stable. Um, tiny bit more certain maybe, but not it's never, it's always fluid, it's always happening. We're obviously not in a recession, and as we just saw from the previous chart, the economists pretty much think we're not going to be in one for at least the next year. So that we keep in mind that the cycle is truly of a measure of the economic indicators. It's not a timeline. So nobody says that your mid period is going to last a year, 6 months, 2 years. There's no timeline affected to it, but the economy does just that. It cycles based on many factors and influences. I sometimes say it pauses to catch its breath a little bit because the economic cycle is a marathon, not a sprint. It appears China is beginning to recover from its recession. Most of us may or may not have been aware that China was in a recession, that Canada has been in a recession. We're so focused on the U.S. economy as the driver that we just lose track of other economies that are sub-economies of the global economy. But the other developed country economies appear to be in the late part of the cycle and broadening on continuing in the late phase or maybe dipping to a recession. It seems like the UK Germany, some of those economies look very close to dipping because they're not really getting a lot of strong economic growth, but they haven't fallen through. Of course, the geopolitical unrest in the Middle East and the Ukraine is not helping the situation in the Eurozone and, of course, the Middle East. So, things that we have to be sensitive to, but they're not driving everything. Well, of course, a recurring question at the moment is okay, Marshall, this is great, nice economic cycle, but in case you hadn't heard, there's an election next week. So, what's going to happen depending on who's sitting in the White House? Well, let's take a look at how that's occurred. And, uh, you know, we got pictures of presidents, and we're going back to 1932 and even through any current economic era that you look at. And what you see is that indirectly, we may see some volatility based on the election uncertainties. We'll see volatility based on geopolitical tensions, as mentioned, or is it really just time? What we've seen that it really hadn't mattered who was in the White House. GDP has continued to remain strong. Yeah, we had 2008, and all of us remember the dip. We remember the Great Recession. But the reality is, when you look over a 3, 4, 5 year period of time, it's not really impacting. As you can see from the chart, GDP has grown no matter which presidential party was in the White House. The only thing that changes is who takes credit for the momentum started long before each president took office. You know, the US economy is a battleship, it's not a jet ski. And so changing course, changing paths generally tends to take a period of time. Now, COVID taught us that things can happen really quickly, but that's a pretty dramatic example of changing the US economy rapidly. So if you're a little upset next week over one candidate or another getting elected, take a deep breath. Know that the election will have little impact on your portfolio or your life, and know that in a few months the dust will settle and we'll be back to normal, whatever normal is. So, yes, folks, you heard it here first. So, Shawn, throughout the political season, we keep hearing about inflation. What's the reality?
So the reality is inflation, as mentioned a little bit before, is kind of been brought back down into reasonable levels. Inflation in 22 is at 6.5%. Inflation in 23 is at 3.4. And today, as we looked at, from last year until 9/30 when we got our last print, we're looking at about 2.4%. Now that's people look at these numbers and go, and it feels a lot worse than that. Well, of course, it's compounding. So these, just because we're not inflating as much, prices are still high compared to where they were 10 years ago. And because you look at the prior 12-month inflation printing 2.4 coming off of what we saw in 23 and in 24, it sounds great. And that's on top of prices increasing by nearly 10% the prior 2 years, right? So it's compounding. So if you're still filling in the grocery store, prices haven't gone down, they just haven't increased as much. So for now, keep in mind though, the FOMC is targeting somewhere around 3% or below, and their eye is on the prize, in my opinion. And I'll talk a little bit more of that here in a few slides. So where does inflation come from, right? So the Fed looks at inflation through the lens of the PCE, whereas the consumer hears mostly about inflation. Us on our, on this side of the news channels, right? We hear about CPI. And the consumer price index is roughly around 2.5% right now. And what that measures is out-of-pocket consumer expenditures. It's front page inflation. It's what the news talks about. It actually is reported first. So that's why most people hear CPI and they think that's what inflation is. Now, it's really just gas and groceries, right? And then the other out-of-pocket goods and services. And while we're talking about CPI, it's only measuring urban areas. So it gets the headline news. It's the fastest thing out. It's the easiest thing to measure. And then personal consumption expenditures came in at about 2.24%. Sorry, 2.25%, and it usually runs about 0.4% less than CPI. So there's always a little bit of a delta there. And the reason for that is it includes expenditures paid by your employers and the governments. Think about health insurance, for instance. The company paid for health insurance. That is going to the economy, is being paid for, but it's not being paid for by the consumer, it's being paid for by the employer. And it also measures urban and rural areas, so it covers a larger demographic. It's a broader measure. Therefore, it takes a little bit more time to process the numbers, get the real figures in, and that is the PCE is what the Fed is going to use to make their decisions. So I say all this to say the Fed's target is to keep inflation, if you will, at 3% or below, which is the case at the moment. Getting into that, we're going to have to wait and see how the election falls, wait for the FOMC meeting the day or two after, and see what they decide to do next. So let's break down expenditures a little bit, or not expenditures, but the inflation. What has driven the inflation? And Marshall and I, when we were putting this together, we were having a little bit of trouble reconciling like this chart, and it's really hard to see. I know there's a lot of detail here, but just bringing it up to high terms, groceries feel expensive. And if you look at the chart over the last 2 years, groceries are the purple line here, right? And to kind of try to explain this chart and about inflation, and just kind of shows you how it compounds. If you look back between September 21 through January 23, you're seeing groceries inflate year over year by about 3/4 to 1.5 points. So all that compounds. So over a 10-year period, you saw groceries go up by 15%, 20%. And that was a huge amount compared to prior years and what we're seeing today as far as continued growth or continued increase in those costs on what people were paying for groceries, because inflation sticks. We're not deflating. Prices aren't going down. But what we are seeing is the cost of real estate, which is the dark blue, the cost of all the insurance, right? Particularly auto insurance is a bigger portion of what's causing the inflation numbers to print higher. And then, believe it or not, it's the dining, restaurants, and entertaining that we're still spending on our economy. Those measures now are the ones driving inflation. So last little point I want to make, if we think back to January and May of 22, we were feeling the energy prices. That was a huge. Gas again was around $4.25 a gallon, and that was a huge part of what was driving inflation. So to say all that, to say the data confirms that what we've all been feeling. Grocery prices spiked and stayed. We've all seen the increases in our insurance renewals. House prices in some regions have skyrocketed. And with the last print at around 2.5%, inflation in general terms seems to be under control, even though it may not seem like that at the moment. And that's kind of how we reconciled. Everyone's saying, oh, inflation's good. No, it's not. Grocery prices are still expensive. Hopefully that helps kind of show you that disconnect about what's happened, where we're at now, and what's driving the PCE and CPI.
Let's get out of our wallets and look at the world. And so we've got the usual geopolitical tensions going on. Obviously, the relationship between Russia and NATO as a result reflecting of Ukraine, that really hasn't improved. We've got now North Korea has decided to join and assist Russia. And so we have that issue going on. The Russian, North Korean versus Ukraine is really causing some humanitarian issues and creating much more risk for investors' capital in that region. So while world leaders are optimistic the conflict is contained, there's always the risk of escalation. There's the risk of increased tension between Russia, NATO, and of course those here in the West who are funding much of the Ukraine defense. Hamas and Israel got a little more conflicted because now Iran has jumped in the mix. And that could just continue causing instability and economic uncertainty in their region, with the same risk of escalation spilling over into some of the oil related companies, and of course, hopes for a peaceful solution. We keep hearing ceasefire, peace negotiations, and then suddenly there's an escalation. There's more rocket attacks. It doesn't seem like anybody over there is eager to come to any short term resolution. The hatred, if you will, the conflict runs deep. And it wasn't something that happened overnight, even though there was the attack a little over a year ago. But the reality is that's been brewing for years. I can even go back to, I guess, 2006, when I was actually over in Africa at the time and remembered some of the conflict that was going on between Israel and Hamas. So this didn't happen at the moment. It's truly been brewing over time. China continues to support Russia, and they keep giving veiled threats towards Taiwan. There's nothing new there. I don't have him up here, but now that North Korea has joined Russia, I always have to have North Korea in the back of our minds that a little bit of a loose cannon, so we have to be careful. Then there's the cyber attacks. What's really new and showing up in the geopolitical radar are the cyber attacks. They're a growing geopolitical risk as these attacks become more sophisticated, more effective, increasingly relentless, and world reaching. They become a significant threat to business and national security. While you may recall the CrowdStrike incident last quarter, that may not have been a cyber attack. The impact on the internet blackout, that impact was felt globally. It'll be interesting to see how lawmakers respond, if at all, to the CrowdStrike blackout and any additional actions taken to thwart cyber threats. Delta Airlines has been one of the first to step up with a $500 million suit against CrowdStrike. So it'd be prudent for all of us to take a few minutes and make sure we're buttoned up on our IT and information security. Hopefully, as Shawn said, nothing goes awry over the next 5 to 6 days with the election. But just be careful, make sure your passwords are up to date, and be cautious of what comes to you via the internet. So lots of tension globally. I suspect that will continue through the remainder of our year and the remainder well into 2025. This didn't start overnight. It's not going to end overnight. Well, in addition to the geopolitical tension, of course, we've got the political tension. The U.S. debt continues to run rampant and unchecked. The Harris-Walz versus Trump-Vance. It's hard to believe. Last quarter we had Biden versus Trump. Now we have a whole new four-party dance going on here. We have the House versus the Senate control and what that will bring, and sort of a now what approach. I've just been amazed at the political promises made by the presidential candidates. I remember a conversation with my father when I was a teenager. I wanted something. I asked him if I could get it, and he laughed and said, I probably really asked him if I could have it. He laughed and said, Marshall, you can have anything you want. All you have to do is go out and earn the money to pay for it. I'm guessing some of you may have had similar conversations with your parents. Of course, I later had that same conversation with my sons, and you may have had that with your children as well. But my point is, other than having a printing press to print more money, the government doesn't manufacture or sell anything. The government earns money via taxation. It may be income taxes, it might be tariffs, could be fees, could be more debt, but it comes from us, the taxpayers, the citizens of the United States, directly or indirectly. So offering to not tax certain sources of income or give a tax credit for certain activities means the money has to come from somewhere else to run the government. So a spoiler alert, we're broke. We have $36 trillion in debt. About 20% of the US debt is held by us, the local investors. The debt ceiling was suspended until January 1 of 25. Can you say kick the can down the road? And to the new administration. So I'd expect there's not going to be much change, especially while the US dollar remains the world's reserve currency. So the best we can do is encourage our lawmakers to address it and, of course, wait and see. We've heard so much from the politicians about cutting this tax for certain people and giving this tax credit. But the reality is so much of the federal budget is fixed. Let me start at the bottom on the left-hand chart. Medicare and Medicaid. Okay, people are not going to stop getting sick. We've been required to have Medicare, and so that's not going to change. Social Security, well, people paid it in. Now they're taking it back out. Defense spending, I hope we can keep defense spending constant, but the reality is with world conflict, that could go up. We have the non-defense discretionary spending. Then we have this thing called interest. We've issued so much debt because we're the $36 trillion in debt that we have this huge amount of interest that we have to pay. Now, this is one of the good things about the Fed's cutting interest rates is that the interest burden, at least as a rate category, will decline. And then there's other. So you've really got about 13% that Congress can control and maneuver around. The rest of it's pretty much fixed. So where did the money come from in the 2024 budget? Well, income taxes, that's our big source. Corporate taxes is next. Social insurance, which is FICA, Medicare. Other sources get about 4%. That's some of your tariffs and things. And then, whoa, deficit. 28% of the budget was borrowed in 2024. That was the plan. Could turn out to be actually worse because of the interest rates being higher and people having to, the federal government having to spend more simply for interest. So there's not a lot of wiggle room. But virtually every politician makes promises they can't deliver on. This is why you need to consider the political feasibility associated with what they promise. They can try, but there's no funds to succeed. Therefore, you really have to focus on the philosophical priorities and actual past track records. Promises are cheap, past results count the most. Well, currently the Democrats control about 51% to 49% of the Senate. And there will be 51 seats in the chamber up for or 33 seats of that chamber up for election. The Republicans control the House, 220 to 212. There are 3 seats that are vacant. It's anyone's guess how control of the House and Senate will fall next week. But what I bring to you is that those are factors that increase our U.S. tax policy and spending policy more than whoever is sitting in the White House. Shawn, I've been preaching to the choir. Help us out, buddy.
Yeah, I think now would be a good time, Marshall, to remind everyone about our save date, where you and I are going to host November 14th at 10 a.m. Our election's over now what presentation. And that'll give us a second to know who the candidate is. So once we know how the House, Senate, and President elections go, we'll be able to begin refining our expectations on how best to guide most of you, our clients, through any potential tax and regulatory policies that may impact you or your businesses. So I'd argue stay tuned. Hopefully by then we'll know who our next president is. Gives them a week to count all those ballots. So please join us. Mark that down. We'll be getting the invites out to you guys as soon as possible. So moving on, one of the biggest items we're following is the Tax Cuts and Jobs Act that was put in place in 2017. It did bring sweeping but temporary reform to our tax policies and changes to the U.S. tax code. And really, the question is, will it be extended? Will it be made permanent, modified, or will it be completely abandoned? Which that last one is I haven't heard much about that. So in some way, shape, or form, it's going to be extended, made permanent, or modified. As many of you know, though, the changes promulgated by the TCJA will expire at the end of 25 if Congress does not act. So that's why, again, we're keeping a close eye on the congressional elections, more so the presidential. Now, we know where the Biden's campaign and the Harris campaign, Harris and Trump campaign fall on that. But again, really paying attention to that and knowing how to help you guys when that does come to fruition. So let's talk about what's at stake. The individual income tax brackets will increase. The top rate goes from 37 to 39.6%. AMT, alternative minimum tax, for a lot of us becomes a lot more likely. There was some changes back then that allowed reduced the exposure to AMT for most of us. Your state and local tax and your mortgage deduction caps go back up or go away. Again, this is if it expires. The qualified business income deduction is eliminated, and there are significant changes to the gift and the estate tax provisions that allow us to pass our estate tax free. Our estate's tax-free, so definitely keeping close eye on that. So top of our list, we'll be the first to know because we're tracking it like crazy. We'll inform you what to do depending on how it lands. For now, though, stay plugged in to what we're doing. Don't hesitate to reach out if you'd like to dive a little bit deeper. Most likely, though, the best thing to do is just hang tight, see how the elections fall. And then tune into our presentation because we're tracking both campaigns. You know how promises are. Marshall said it earlier. They're going to promise whatever they need to do to get some votes, both sides. And then once they get in office, we'll be able to really pick apart where their campaigns or promises are, what they can actually achieve, and kind of what direction we're going to go into so we can start planning. Marshall, let's turn it back over to you and talk about interest rates.
Yep, a critical driver for us, of course, is U.S. borrowing cost. The 10-year yield has declined to 4.1 from 4.25 last quarter. The driver, of course, is the start of the FOMC rate cuts. So we got that one when, it didn't quite drop the half, but it dropped close to a quarter. We've had near record high home prices around the U.S. that just continue to make it more difficult for first time buyers to compete. At 6.9%, that's about triple what the rates were just 3 years ago. So, according to my realtor clients, the biggest hurdle is still supply. New home sales, new construction home sales continue to flourish, but existing homeowners still aren't willing to give up that 2.5% mortgage. So, those homes are just not coming on the market. Now, congruent to the 10-year Treasury, the mortgage rates have continued to decline, but of course, without the home sales, the demand for mortgages is still dismal, and mortgage refinancing is really all but non-existent. I wanted to take a look at this graphically about the 10-year Treasury yield. This is just over the last 6 months, and we watched it drop from 4.6. We saw the dip that came with the Fed cut in the summertime, but it's rebounded back up. As you can see, the rates have dropped and rebounded, and we've got that in there. But the drop, of course, has happened, and the rebound is related to spending promises of the candidates. There's growing concern that the spending that may take place could further cause a decline in the credit rating of the United States. We saw where that was adjusted a year or so back. And there's beginning to be some concern that if the deficit does not become under control and interest rates still remaining up there, that the credit rating for the US could be reduced again. So just something to stay tuned for. Here's the impact on the home sales. And of course, with rates up where they are, and once you've had the taste of 2.5, that's pretty sweet. And you get back up to that 6 and change, that's pretty sour. So many buyers are just staying on the sideline in anticipation of near-term additional rate cuts and rate declines before making their home purchase. I'll go out with a little prediction here, if the Feds do another 0.5 or 0.75% rate cut between now and the end of the year, we could very well see some homes get back on the market and get rolling. Here's a good graph that shows you what's happened to existing home sales, and we've dropped below that traditional average of about 3 million. We saw that 2020 peak when people we had to work from home, but I'm going to call it the work from anywhere period, when there was the mass exodus from the Northeast and the far west to the Sun Belt states, especially Texas and Florida. So as a result, we're starting to see that taper off, and that limited inventory is going to be a factor. So Shawn, I talked about changing for labor, for jobs. Why don't you bring us up to date on the labor market?
Marshall, employees continue to add jobs. More people are getting back into the workforce. With the FOMC targeting anything below 5%, we'd say unemployment is in line and in a really good spot. If you look at the slide in December of last year, we were at 3.7, March 24 at 3.8, June 24, 4.1, and September 24 at 4.1. I believe we have an October print. We didn't get it in here, but still under 5%, really good, strong labor market. Kind of shed a little light on that. The Bureau of Labor Statistics reported as of 8/31, unemployment was at 4.2%, down to 4.1 for September. So the difference in the 2 months, down 0.1%, shows a little bit of strengthening there. The first, where the U.S. jobs was at 8.04 million openings, that is, and it's down to 7.44 for September. So Again, strong labor market, people are getting back to work, unemployment is still pretty low. Getting into the consumer confidence side of things. Now, tying all this together, I think this is going to help. The U.S. consumers say they are feeling so about the economy, and I've heard it, right? You know, you talk to people who aren't really plugged into the economy and the market, like most of us are that are on this call, or of us in the business. And despite inflation's negative impact on purchasing power and sentiment, consumer spending growth has been remarkably resilient. As we showed you on that color chart earlier, it's one of the biggest things contributing to inflation right now. Consumer spending. Despite the lower inflation, low unemployment numbers, decent job openings, rallying markets, I'll throw that in there, and strong earnings each quarter. Like it's astounding to me that everyone still thinks that there's a negative inflation impact out there. Well, why is that happening? In my opinion, it's simple. Consumers have jobs and they have money. Not as much as they once had, but what they do have, they are still spending. And really, it's easy to blame the politicians, right? The barrage of campaign ads reminding everyone that the economy is bad, so elect me, I would say is the absolute narrative and culprit on why Americans believe that the economy is in a bad shape or the inflation is killing everybody. So this apprehension still hasn't kept Americans from reaching for their credit cards. They're spending their last cash reserves, increasing debt on traveling, and enjoying their YOLO life. You only live once life. So as a side note, the October numbers were just released and the index jumped to 108.7. So as we were putting this together, consumer confidence is starting to tick back up a little bit. I feel like a lot of that, again, gets back to the rhetoric from both campaign ads. I think it's just making everybody nervous, but the data doesn't lie. So let's talk about the LEI. It's implying a continued decline. That's the Conference Board Leading Economic Index. It continued to contract slightly, which does provide some insight into some lower consumer confidence. Again, there's moving targets here, but the interesting thing is that for 24, consumer confidence has dipped more than leading economic indicators. So there's that disconnect, right? The leading economic indicators, the math says we're doing great, but the consumer confidence and the implied feeling about it, not so great. So consumers are feeling the economy is worse than it actually is. So I'll leave it at this. Honest Abe once said, don't believe everything you read on the internet. So seriously, folks, be careful what you read on the internet. The noise is loud, especially with the political campaigns. The economic indicators are really strong. Marshall and I spent the last 45 minutes kind of running you through all that. Just stay focused. All right. Try not to get riled up in the last couple of weeks, last couple of days here for the election. And I'm here to say, again, eternal optimist, we're in a good spot.
Investing in uncertain times. I love this slide, and I'm always hopeful there will be certain times one day. So here we go. What happens if your candidate or the other candidate gets elected next week? Well, what has happened? Virtually no impact. Uh, I've given you two graphs with pictures of presidents on here. So indirectly, we may see some volatility based on election uncertainties, geopolitical tensions, as mentioned. But the reality is, again, policy is much more important and impactful on the companies that we own than politics. As you can see that the chart from the S&P grew no matter which presidential party was in the White House. The only thing that changes is who takes credit for the momentum. And we know that, again, I'm back to my battleship comment, things get started long before each president takes office. So if you're a little upset over one candidate or another, again, take a deep breath, know the election will have little impact on your portfolio, and we'll settle back to business as usual. But the market will fluctuate. This chart shows us the blue bars show us what happened, what was really the return for that calendar year. And then the orange dots, and since it is Georgia Florida weekend here in Jacksonville, I do have an orange and blue slide. I slipped one in here. We've got the orange dots that show you that at some point during that year, this is how bad the market fell. And every time my eye goes to 2008, 2009, we're at 49 and 52%, and I can still feel that pain. But the reality is it came back and we were up 26%. That same year we were down 52. So we have these adjustments and and corrections, and that's just part of the swing. That's part of being in the market. And the usual driver for these things is one simple word: uncertainty. When people don't feel like they have a good handle on what's going on, they tend to get a little tighter fisted on their wallet, and that's uncertainty. So we're hitting market highs almost every day. So the question comes up with new clients more than anything else to say, well, wow, should we wait till the market cools to invest cash? Or better yet, there's certainty in the market. When is a good time to invest in the market? So the key word is to invest, not speculate. In the short term, anything can happen. Chairman Powell might sneeze, but for the long term, being an investor, the chart speaks for itself. If you invest on a peak day, invest at the new high, you can see that in the 3 months that can have some impact to you. But over a 3 year period, it didn't matter. You would have gotten a better return investing at that new high. Now, you have to realize, of course, that returns have historically been slightly better when investing at new highs simply because the momentum that people are feeling good about the stocks and they're coming in there. So don't let the fact that the market is doing well deter you from participating in the rewards that are out there. I always love this chart. We run back on this thing to 2008 and the Great Recession, and it's almost a linear progression. Yeah, we had the 2020 dip, we had the 2022 dips, but the reality is staying the course is such a key when looking at the S&P 500. The bull market continues. Are we due for a correction? Yes, we're always due for a correction. I'm going to show you that in just a minute. But keep in mind, corrections are declines of 10% or more, but less than 20. A bear market that you see in in the red shades, of course, or pink shades, those are declines of about 20% or more, and recessions are shown in gray, which are very tiny in here. So what happens? Well, we have a bear market or greater than 20%. There's a 0.3% chance that happens in any given year, but a dip of more than 3% should happen about 7 times a year. That's about every other month. So I wanted to share this chart to reflect just how frequently the market takes a breather and the depths of those breathers. So don't worry, don't panic when things happen and go up and down. That's just part of the normal process of things. Now, this next slide, and I'm going to apologize, I recognize this is busy, and I'm going to leave this up here for a minute and then give you some thoughts about it. The key word when investing, of course, is diversify. And I apologize again for the busyness, but there are a lot of options to invest your portfolios, and each of those particular asset classes has merit. However, this year's winner may be next year's loser. Now, if I can direct your attention to the dark green, the really dark green, those are commodities. And they're generally been in the lower 2 boxes almost every year. And look what happened in 2022. 2022, commodities goes from, the basement to the penthouse in virtually a year and change. Well, what happened? Well, commodities, of course, are things like pork bellies. Go back to trading places with pork bellies, orange futures, lumber, all those sorts of things. And when inflation happens, of course, you see commodities go. They're a very inflation sensitive investment. Now let's look at large cap stocks, the lighter green. The lighter green ones, as you say, they usually are up above the mid-range point in here. Well, let's think about that for a minute. Those large companies have the capital to adjust to the market and do what they need to do to remain the leaders in the market improvement. They remain in the upper area. Let me talk about REITs for a minute, real estate investment trusts. You see the light blue, and you can see periods where real estate investment trusts are awesome. But again, let me direct your attention to 2020, 21, 22. The REITs within a 2-year period went from bargain basement to penthouse and back down to bargain basement in a short period of time. So the key is to keep a diversified portfolio that meets your particular risk tolerances and goals. And notice how an asset allocation portfolio, the white boxes, generally to have good returns virtually every year, but it's blended. It's a blend of all of the asset classes. So those categories give you a little less acid indigestion, if you will, for the market volatility and fluctuations. But Shawn, as we all know, it's different this time, and there's always a good reason not to invest in the market.
Yeah, sure enough, Marshall. You opened up this whole section discussing investing in uncertain times. And the only thing I can do to add to this is to remind all of us that the only thing constant is change. And I'll admit that there's an old Greek philosopher that I can't pronounce his name. So you'll have to go look that up on who said that first. It wasn't me, but that is so true. And the title of this slide says it best. There's always a reason not to invest, not to buy stocks, right? Except for 2006. I'll let everybody look at that real quick and get a good little chuckle. Not a bad year. Pluto was demoted from planet status. We've been throwing this slide around for years, and we'll continue to throw this slide around. And our partner CPS, I believe, are the ones that put this slide together. They throw this slide around because it's so powerful. There is always a reason not to buy stocks. And as you saw from the charts over and over and over again, the market generally is up 75% of the time. And then for 2024, right, what will be the reason this year? The election? Who knows? It's not over yet. Ukraine, Israel, China, something else no one saw coming. Again, the year's not over yet. Again, so just think back to COVID. What happened in 2000, right? COVID shut the economy down, shut the world down. Markets dropped 30% in about 60 days. We thought it was different this time, but it wasn't. And I've been in the business long enough. I've been helping clients long enough. I've lived through it personally with my family and family's family to have been through some of the major recessions from 2000, 2008. Again, COVID, and really see and feel how the market continues to drive on. And, know that while it may feel different with a different person in the White House, the resilience, ingenuity, and drive of the American entrepreneur to make a profit will outlast any temporary market fluctuations or any conflicts here, there, everywhere. Have confidence in that. Have confidence in your financial plan. Have confidence in us as your advisors. And if you need help, we're here to help you see through it. So with that being said, some sound economic and financial planning principles never go out of style. Don't forget the basics. We encourage all of our clients to make sure they're on track for achieving financial independence. That's a lot of times that's where I start when I sit down with a client at first meet and say, hey, where are you? Where do you need to be and where you want to be? Let's get you on track for financial independence. Once that's in place, we help you protect that. And a lot of that is what's also on this slide. What does the overall financial plan look like? Risk management. What are you doing to protect yourself if something were to happen to a spouse, a business partner, a key employee at your office? How are you protecting those assets that you're working on that produce income for you, that are building your financial plan, that building your financial independence in the future? Education planning. A lot of us, kind of push it aside or want to dip into our retirement plans to pay for juniors college. Well, let me tell you, there's no financial aid for retirees. There's financial aid for students. So again, looking at your plan holistically is the way to go. Never goes out of style. And investment planning is really just tying in, and I love Marshall's Callan periodic table, that real busy chart with the white squares in the middle on diversify. Really, investing should be that. It should be find your white box that gives you an average return that ties into your financial plan, right? And then for us, and what we do specifically for our clients is looking out for minimizing income taxes. People, all of us, I'm sure, understand on some of this call, but if you're not coordinating your income tax planning with your investments and your financial planning, you're taking a big ding out of your future wealth. So looking at how to hedge inflation, how to prevent and practice the estate and death stuff, you've got to be looking at minimizing taxes. So again, rest assured, we're here for you. Marshall and everybody, thanks for having me on the call today. I look forward to doing many more of these with you. If anybody has any questions for me specifically, please feel free to reach out. Marshall, turn it back to you, sir.
John, before I take the ball back, we've had some questions that have come in. I
Okay,
want to send the first one to you if we can.
sure.
This was someone who is asking that as market rates are declining, when should I consider refinancing?
Oh, good question. Loaded question. We need to, that's a phone call into us. Let us know where you're at. What rate, you have to ask yourself, what rate do you currently have? The heuristic is if you can save a point or two on the rate that you currently have, it may be worthwhile. How does it tie into your financial plan? And then there are other ways to eliminate that debt. If you have a low interest loan, it may be best just to pay it down over time. Or if it's just a float note because you're building a property, there's a lot of hair on that. I would say reach out, give us a call. Let us walk through that one on you.
Shawn, before I wrap, did you have anything else you wanted to add just before we depart?
No, just to thank everybody for having me on. Marshall, thank you for having me. Did anybody post anything in the chat about where they thought interest rates were going to be? I'm curious what the
No,
sentiment
we
is of
didn't
our
see
group.
anybody vote. I've got a couple of comments in here, but nobody, I think everybody's a little too shy to throw
All
that
right.
in. I could ask for an election poll, but that could get violent. So we don't want to do it. We
Yeah,
try to stay as
let's not do that one.
apolitical as possible, even though I know most of the folks on the screen and I know where their election leanings are. But no arm wrestling available through the chat box.
Understood.
So,
The
well,
last thing I
folks,
would say, just as a public service announcement, I know Marshall, you and I sent letters out to all of our clients, but if you're not a client of ours yet, and you own a business, make sure you get your BOI filed. If you don't know what that is, or if you don't know how to do it, give us a call. We'll guide you on that one. And then also for our business owners, if you have not scheduled your year-end planning with us yet, your tax planning, please get with us. If you haven't heard from us yet, trust us, you're on the list to be called. So again, thanks for having us, and let's get that planning done.
thank you, Shawn. Appreciate. Glad to have you on the team. So, remember, the next few days could be very volatile. Next couple of weeks could be volatile as we try and find out who's going to occupy the White House. However, keep in mind, over the long term, again, it's policy, not politics, that drive the economy, and the economy drives the market. It is as much about who lives in the White House, but how are the House, Senate, and White House controlled? If there's a balance of power, not much will get done, not much will be accomplished, but there will be lots of politics to scare the market. So always build your investment portfolio with companies whose profits are not tied to politics. Regardless of who's in the White House, people will continue using their Charmin, eating, dining out, taking their drugs, and using their cell phone. The American consumer has proven they will not give those things up. One last passing comment, of course, is please vote. This is actually a picture of the Freedom Tower at Ground Zero. You can see it behind the supermodel. November 5th is the election. If you haven't voted, please do so. So, with that in mind, our next scheduled event will be, as Shawn mentioned, our post election special presentation. The election is over. What do we do now? We're going to hold that Thursday, November 14th, 2 weeks from today at 10 a.m. We sure hope the election is over and we can go back to only personal injury attorney ads on TV. We will also be scheduling our annual economic update on Thursday, January 30th, 2025 at 10 a.m. Watch your email for details. I'm certain it will be interesting. Thank you for joining us. We look forward to meeting with you soon. Take care, be safe, and have a happy Halloween.